In this lecture, we are going to talk about RBI. So, this is the first lecture of the series of lectures on RBI. We'll be talking about why was RBI created, what is the organization structure of RBI, and different aspects related to functioning of RBI. So, first of all, what is the origin of RBI? In 1926, the Hilton Young Commission recommended formation of a central bank to separate control of currency, credit, and banking system from the government. So before 1926, what used to happen was the activity of control of currency, credit in the entire system, as well as control of the banking system lay with the government of India. So that was changed after this Hilton Young Commission's recommendation, wherein it said that there should be a central bank which is autonomous or independent in its functioning and which is responsible for control of currency in the economy, amount or volume of credit in the economy, and regulation of banking system in the economy. So first of all, in 1935, it was created as a private shareholders bank, wherein the shareholding or the ownership of the central bank lay with the private shareholders. It was nationalized in 1949 and it became a wholly owned entity controlled, not controlled, wholly owned entity of the government of India, wherein the shareholding lay with the government, but there were certain rules and regulations which were created so that RBI could maintain its autonomy. So, in the functioning of RBI, whatever it would do after independence, there was a lot of autonomy which was provided to RBI to ensure that the control and regulation of currency, credit, and banking system lay completely with the RBI, and government has had no say in these activities. So the need for RBI, why was it realized, that we've already discussed with the origin. Let's go through this in this statement. The statement says a central bank is an independent apex monetary authority which regulates banks. Number one, as we've already said, provides important financial services like storing of foreign exchange reserves. This is very important. So foreign exchange reserves, the responsibility of storing forex reserves as well as deciding the amount of foreign exchange reserves that are to be stored, that are to be kept in the in an economy is to be decided by the central bank. Control of inflation, monetary policy report, financial inclusion, and various other activities. That is the need. That was the need that was felt for creation of an independent central bank, which was created in the form of Reserve Bank of India. Next is, what is the organization structure of RBI? So I have not mentioned the entire organization structure. It starts from grade B officer level for which you are aspiring. Below that there are two levels. There is assistant and there are grade A officers as well. Now as you go up from grade B to grade J is the governor. Below that is the deputy governor, and below that there are executive directors, and then there is a list of, or there is a committee of central board of directors wherein there are 21 directors in total, which includes the governor as well as deputy governor as well. Now let's talk about supervision of banks. So first of all, the difference between supervision and regulation is that in supervision of banks, the RBI carries out regular supervision wherein it checks its balance sheets of banks, it audits banks or counter audits banks, whatever audit has already been done by banks before, and in that process it finds out whether banks are in a strong position to carry out this business or not. And regulation, on the other hand, is done by RBI, wherein it regulates the activities of banks through various policies, through various rules and regulations, but does not carry out checking of balance sheets and audit of these banks. So that is the basic difference between supervision and regulation of banks. Now supervision of banks is carried out by a board in RBI which is called as Board for Financial Supervision, and the process of carrying out supervision is through CAMELS as well as through CALCIUS system. Now there was a question in 2015 wherein the CAMEL system was asked very straightforward, in a straightforward manner, wherein the full form of CAMEL system was asked in the examination. So this becomes important, and similarly CALCIUS system also becomes important. So we'll be talking about these two very shortly. Now Board for Financial Supervision carries out supervision for which all entities? Number one, commercial banks expected. Number two, financial institutions, NBFCs, urban cooperative banks as well as primary dealers. So these all entities come within the scope of Board for Financial Supervision for carrying out supervision of banks by RBI. Now what is this CAMEL system? Let's understand that. The full form of CAMEL system starts with C, which is capital adequacy. Now, capital adequacy here means the ability of banks to cover the risks. And how is it calculated? It is calculated through this formula: Tier 1 capital plus Tier 2 capital upon risk weighted assets. It is also called as capital to risk weighted assets ratio. So, what is happening here is all the assets of the banks. So, what are these assets? Assets are nothing but loans which are provided by banks to various entities, organizations, companies, or individuals. Now, all these assets have certain risks involved, because all these loans which are provided by banks to various entities may be returned or may not be returned. Now, if they are not returned, then it is a loss for the organization, for the bank. Therefore, there is certain risk attached to every loan that is provided by banks to various entities. That is calculated in the denominator, and in the numerator we have Tier 1 capital as well as Tier 2 capital, which tells us about the ability of the capital to cover the risks associated with these loans that are provided to various organizations by banks, and that is what is capital adequacy. So, ability of the capital which the organization has, which every bank has, to cover the risks associated with the loans provided by the organization, by the bank, is called as capital adequacy, and it is measured through capital adequacy ratio or capital to risk weighted assets ratio, one and the same thing. Next is asset quality. A stands for asset quality, which is nothing for but quality of loans provided by banks. So, what is the level of diversification in the loans that are provided by banks? Number 2, what is the quality of loans, which means that which all organizations are being provided loans, what kind of organizations are being provided loans, how much restructuring of loan has been done by the organization, what is the level of provisioning that has been done for loans that are provided. So, all these things combine together to tell us or give us an idea about the asset quality of these loans that are provided by banks. Next is M. M stands for management. So, C was capital adequacy, A was asset quality, M is management. M involves two things: ability of the management to react to financial stress and ability of the management to carry out safe operation of the bank. You need to remember these two words. It is very simple: the ability of the management to carry out the operations of the bank and to react to financial stress or problems that arise in a bank. That refers to as efficient or inefficient management in the organization or in a bank. Next is E. E stands for earnings. Earnings means the following things: company's growth levels, stability, valuation allowances, net interest margin, net worth level, quality of company's existing assets. All these things combine together to tell us or give us an idea about the earnings of a particular bank. So, what is the growth level of the company? That is compounded annual growth rate, which means the annual growth rate of the company with respect to assets, with respect to earnings, all these things. Stability of the enterprise also gives us an idea about the quality of earnings in the organization or in a bank. Valuation allowances, net interest margin, net worth level, which is nothing but capital of the particular organization. Quality of company's existing assets, because that determines the earnings of the company in the future, earnings of the bank in the future. And next is L, which stands for liquidity, which is ability of the particular bank to convert its assets into cash in a short period of time. So, interest rate risk sensitivity, because interest rate risk is a short term liability, and therefore the sensitivity of interest rate risk to liquidity of the organization. Availability of assets which can easily be converted to cash, dependence on short term volatile financial resources, and asset liability management technical competence. All these combine together to give us an idea about the liquidity of a particular bank. And next is sensitivity. Sensitivity means management of credit concentrations, which means the level of loans that are provided by banks. What is the concentration of those loans? What is the sensitivity of failure of a particular kind of loan to the failure of the organization itself? How lending to specific industries affect an institution? So, if you are lending to specific industries, for example, you have lent a lot of money to steel industry, then how is it affecting the sensitivity of the organization to failure of the steel industry? For example, if the steel industry fails today, then the sensitivity or impact of this failure on the survival of a particular bank, let's say SBI, that is what is called as sensitivity. So, these are all part of Camel's system. Now, Calcius system is similar to Camel system, with only difference being C here. So, C stands for capital adequacy, asset quality, L is liquidity, S is sensitivity, and C here is compliance. So Calcius system applies to foreign banks, wherein compliance by foreign banks to the rules and regulations prepared or carried out by RBI is becomes a very important part of functioning of these foreign banks in the country, and therefore compliance becomes an important part of Calcius system or supervision for regulation of these foreign banks in India.